Good afternoon, friends, and thank you for inviting me here. It feels like a real homecoming. And if you look at the last 18 months, foreigners have sold almost $40 billion worth of stock in India. And who could have said 18 months back that even if they sell 40 billion worth of stock, markets will remain flat. So I think all of you have played a very important role in this, and 3 cheers for the mutual fund industry, 3 cheers for IFAs, MFDs, everyone else. I think this experience of last 15 months of flat markets, the large caps have been flat, when so much of foreign intense selling has been there, tells us how the volatility of Indian markets has collapsed. So equities are a volatile asset class. They are not risky. Most people think equities are risky. I think we need to distinguish between risk and volatility. So they are a volatile asset class, but if you invest in a sensible way, they will seldom cause loss of wealth or loss of returns over time. But fortunately, even that volatility in India has gone considerably down, and this data is available in charts of volatility. So I think Indian markets in future should deliver returns, to my opinion, with a lower degree of volatility compared to the past. At the same time, the returns are likely to be much lower than the past. So if you go back 30 years, 20 years, we used to often discuss that Sensex Nifty should compound around 15%, 17% a year. I think going ahead, I would say market should compound around 11-12% a year. And the reason for that is very simple. Over last 30 years, 25 years, we have progressively opened up the economy. Look at any product, look at any service which a consumer wants. We are flooded with choices. Every industry is seeing increase in competition from new players, from new age businesses, from alternate forms of delivery. So there is absolutely no product or service which is in short supply. We are spoilt by choice. Therefore, in such an environment, the pricing power of businesses has come down, and therefore the inflation in India, which used to be in high single digits, if you look at the core inflation now, it is running around 2.5 to 3%. In fact, the RBI governor in the last 2 monetary policy sessions, he has said that India is facing a great environment, low inflation and accelerating growth. So if core inflation is stabilizing around 3-4%, even if the real economy grows around 6 to 7%, the nominal GDP growth is only 10-odd%. Look at the budget document year after year. Look at the assumptions of the growth in tax revenues, corporate tax revenues. It is now growing in low double digits, 11-12%. So I think going ahead, we should expect corporate profits, this economy in rupee terms, and therefore the markets also to compound around 11-12% only. Unlike the US, which has many non-linear businesses, where profits can grow much faster than the top line growth rates, in India, unfortunately, we do not have such businesses. Most of our businesses are linear businesses, that profits will find it difficult to outperform top line growth rates over long periods. And that's why you see we experience a very high correlation between nominal GDP growth in India and the returns of stock markets. Today, the markets are fairly valued. If you look at the last, would anyone like to guess what is the last 10 or 20 years CAGR of Nifty? Do you remember? Yes, it's 11 and 13%. 11% for 10 years and 12% for 20 years. So I think this is indicative. If you don't have to refer to any chart, nothing. You just look at the trailing 10 and 20 year returns. They are 11 and 13%. they are in line with the nominal GDP growth over this 10 and 20-year period. That is telling us in very clear terms that these are fairly valued markets. So we should not expect to make returns by way of multiples going up. The last 5-year returns were excessive. It is often said that the best investments are made in the worst of times and the biggest mistakes are made in the best of times. So 5 years back, because of COVID, the markets had collapsed. The large caps fell 20-30%. The small and mid caps fell 60-70%. And from that low base, the returns have been much higher. But that clearly cannot be extrapolated, and that is now reflected in the normalization of even the 10 and 20-year returns. So I would say that going ahead, I would expect these markets, the Nifty, to compound around 11-12%, but it has two benefits compared to the past, two extra benefits. One, the volatility should be sharply lower compared to the past. And number two, what has changed is taxation. So until few years back, you could invest even in fixed income at lower tax rates. That option is not there anymore. So a fixed income will typically take close to maybe 12-15 years to double your money post-tax. I think equities can still do it in about 6 odd years. So if you take a 15-year view, equities 100 can become probably 500 or thereabouts. So I think the gap in wealth creation between equities and fixed income continues to be extremely attractive, and what's more important is that these returns should come with lower volatility because the amount of local money that is getting into the markets. I think one issue what I have experienced when I meet a lot of people, and even it came through in the previous talk, is the popularity of small and mid caps in this phase. So let us analyze why did small and mid caps give high returns in the last 5 years. See, if 100 falls to 30 and if 100 falls to 70, in the normalization journey, think of it this way. Pre-COVID, let's say large cap and small cap both were at 100. In 6 years, COVID was 6 years back. In 6 years, 100 should have become 200. So Nifty prior to COVID was 12,500. It fell to 8,000 and it has gone up to 25,000. So it has become 2x from the pre-COVID levels. And from the bottom, it has become 3x because 8,000 become 25,000. In the case of small mid caps, the fall was much sharper. 100 became, let's say, 40. Now 40 has become 200. It is up 5x. And pre-COVID, there were roughly 3 crore unique demat accounts in India. And today, there are 12 or 13 crore unique demat accounts in India. So what has happened, this 7 or 8 out of 10 investors have experienced much higher returns in small mid caps post-COVID, and these investors have no experience of markets pre-COVID. And therefore a view has gained ground that smaller companies will create more wealth. And because of this momentum, because of a lot of money going into that space, these stocks are not at 200, but they are a lot higher. So I think this is something that investors need to be cautious about, that there are times when small mid caps do exceedingly well and there are times when they will underperform. I think, in my opinion, presently the large caps are much better placed than the small and mid caps. In small and mid caps, the number of companies is very large. So if you look at outlier results, you will always find few companies that will do much better than most of the large caps. But we cannot extrapolate that for the category. So I feel that it is possible that many portfolios are overexposed to the small mid cap space, either directly or through funds, etc. There should be a relook at that strategy. I think going ahead, the large caps should continue to do better, as has been experienced in the last year or so. I think the future outlook of India's economy is one of the best that I have experienced in my career. And why do I say that? If you look at last 40, 50 years, one, India has grown virtually every single year. COVID was the only year where India did not grow. But that clearly, we know the reasons extremely well. But apart from that, every single year, the Indian economy has grown. Even in the year of Lehman crisis, we grew. So why does this economy grow in such a steady fashion? And by the way, India is not only one of the fastest growing economies in the world, it is also one of the least volatile economy. If you look at the standard deviation of economic growth across countries, India's volatility is one of the least. So why do we not just grow but grow with low volatility? And why should the future growth rates accelerate? So I think India has been growing for the same reasons what we have been talking about for last so many decades. Our population continues to grow still. Earlier it used to grow around 2%, now we are growing around 1%. I think South is pulling down India's growth rates because your population is not growing. So you need to work harder now, right? So you are pulling down the national average, otherwise we can maybe grow 7 or 8%. So, but still India continues to grow around 1.25% in terms of population growth rates. Second, the joint family is slowly breaking up. It goes hand in hand with urbanization. So as families become smaller, as four brothers stay separate in four houses, you need lots of things like a home, refrigerator, TV, all of utensils. So the number of households growth is much faster. Maybe it's growing 2.5%, 3% a year. So that leads to that much growth in consumption. By the way, in China, about 15% of the homes are a single person home. So in India also we are seeing that the marriage is less attractive to the next generation and the average age of marriage is going up. So I think this trend of reducing family sizes, reducing size of households is here to stay. India is extremely rich in natural resources, we know that. We are deficient practically only in oil. But I think time is coming when we have something more valuable than oil itself, and that is sunlight. So the amount of solar radiation that India gets is truly of a very high intensity. The entire country gets sunshine 365 days a year. Not all countries in the world are blessed like that. The cost of storage of electricity continues to drop very rapidly. And therefore, solar power in the next few years should be able to supply power even when there is no sun at night. So BESS, battery electric storage, is becoming quite competitive. And I think in the next 5-10 years, as that happens, as we can use more solar energy, as we transition from petrol diesel vehicles to ICE vehicles, as we use more solar wind in power generation, I think it will be hugely positive for India on two accounts. One, it will clearly lead to a far greener environment, less pollution, which is a challenge of the day. And two, it will help us to sharply bring down our oil imports. Oil imports, by the way, have come down from 5% of our GDP 10-15 years back to below 3%. And this is one important reason why India's current account deficit, which used to be around 3%, is now stabilizing below 1%. And this is one big change from the past, which should lead to faster economic growth, lower vulnerability of this country. In the past, if you recall, if you go back 10 years, India used to fund its current account deficit with not FDI, but with FPI flows. So we used to rely on portfolio flows to fill our current account deficit. if portfolio investors walked out of the country, we would have a balance of payments challenge. Look at last year, 40 billion has gone out, but we have not felt the pain. So India's current account deficit has fallen structurally. One, because of falling oil imports, and two, because in the last 5 years, especially post-COVID, GCCs, Global Capability Centers, have ramped up. As remote working has become acceptable, the number of jobs that are coming to India in the India offices of the global companies is now at 2 million. So there are 2,000 GCCs in India operational, employing about 2 million people, and they bring in between half to 1% of GDP as foreign exchange earnings. It is because of these two reasons that India's current account deficit has fallen structurally, and this is one key driver of faster economic growth in India going ahead. Coming back to the drivers of growth, we have great human resources. We all know that. So I will not dwell in that. But in services, India is what China is in manufacturing. There is no country in the world which will bring together millions of young, talented, skilled, technically qualified people to work at globally competitive rates. And so India is really blessed in human resources, and that is a key driver of growth. I think if you look at reforms, this government has done a wonderful job. Last 10 years, we have improved our physical and digital infrastructure considerably. Go to any intercity road. Roads are good, railways are good, airports are good, there are no power shortages, telecom is good. So I think the physical infrastructure in India is vastly improved. Our digital infrastructure is one of the best. And what is the government focusing on now? I think it is focusing on two things. One, they are trying to reduce friction for businesses. So simplification of taxation, simplification of labor laws. RBI recently collapsed few thousand circulars into few hundred circulars. So both the regulators, SEBI and RBI, are working to simplify things. So government is trying to speed up the judicial process also. So I think now a lot of effort is underway to reduce friction for businesses, to improve ease of doing business. And the second thing what government is focused on is to aid progress in manufacturing, because this is one area where we lack. I'm sure you have heard a lot about the PLI schemes. I think these schemes are working quite well. Next year, India should assemble about 25% of the Apple phones. If you look at the production of solar panels, solar cells, it has gone up very sharply. If you drive a Mahindra electric vehicle, it is comparable in experience and quality to a Tesla or a BYD. So all of this, why are these three examples important? Because in these three areas, we had virtually no ecosystem, we had virtually no track record. So if we can start assembling electronic products, and now we are moving backwards into components, if we can start making the solar equipment, if we can start putting together EVs, it tells us that the capability is not missing in India. With the right amount of effort, some support of the government, I think we can make it happen. And therefore, we are seeing a lot of promise in the manufacturing in India. I think one thing which is working to India's favor in bringing manufacturing to India is one, geopolitics and the capital markets. So let me explain. Geopolitics, we all know that the world wants to reduce its over-dependence on China, and therefore they are keenly looking forward to an alternative, and therefore India is extremely well placed. By the way, this country is friends with US, Europe, Japan, Korea, Russia, Israel, Australia, you name it. We are on friendly terms with virtually every country in the world, and that's a great position to be in, which means companies from all over the world are happy to do business with us. So, how are capital markets going to aid this manufacturing in India? So, something unique happened in India in the last 1 year, 18 months. It was the first time that Indian capital markets experienced something like that. Would anyone like to take a guess? What am I referring to? It has never happened before. In the past, we always used to experience MNCs increasing stakes in the Indian arms. Yes or no? So lever stake went up from 51 to 74. Every company was increasing stake. What happened in the last 1 year? Lot of multinationals sold down their stakes in the Indian arms for the first time. Hyundai listed, LG listed, Tenneco listed, Carraro listed, Whirlpool sold down stake, GE sold down stake, BAT sold down stake, ZF sold down stake. There's a long list of companies which have sold down stakes in their Indian arms and which listed. While this did put some pressure on the net FDI. So when a PE sells stake or when a Hyundai lists in India, that money is converted to dollars and it goes back to the home country. So it did put pressure on the net FDI in India, and that's why the rupee was weak. It was not weak because of any weakness in the current account, but because of net FDI fell. But once Hyundai lists, once LG lists, then what happens? 30, 50, 70% of your market cap is in India. Now India will get discussed every quarter in the boardrooms. Indian analysts will ask, what are you doing in India? The more profits you make in India, the more value will get created for that multinational group. So now there is a clear incentive for these companies, multinationals, to invest more in India, to do more business in India, to increase their profit pool in India, and this should aid their valuations globally. And this has happened because these spaces are very richly valued in India, especially compared to outside India. So I think capital markets have been a draw for multinationals to list in India, to invest more in India. And these large global companies have the technology, the brands, the distribution, the capability, the expertise to manufacture in India. Indian companies will not be able to do it on their own. So it is very important for the multinationals to come to India. While government is doing its bit, the local market size is attractive, but I think capital markets also have played an extremely important role in getting these multinationals to invest more in India. So I'm quite optimistic that, in fact, we are seeing a lot of entrepreneurs based in US, NRIs or some other countries who have small manufacturing setups there. They are now coming back to India, putting up much larger facilities because capital is not a constraint and the valuations here are far more attractive than what they will get in US or Europe. So we are seeing the emergence of many extremely promising companies in the manufacturing space. And the low current account deficit and the resurgence in manufacturing that we are seeing, I think has the potential to over time accelerate India's growth rates from 6 to 7% to maybe 7 to 8% in the future. So I think I remain extremely optimistic about India. In fact, as I said, this time at present we feel the most optimistic about India compared to any other time in the past because manufacturing seems to be working for India. The reputation, the visibility, the comfort that India enjoys on the global stage is unmatched compared to the past. Now, what are the risks? What could go wrong? See, risks by definition is not known. I mean, who knew COVID was coming? Who knew tapering was coming? Who knew Lehman was coming? So at the risk of not knowing, if one has to guess, some people say that AI could be a risk for India. That's the most obvious risk. You export $200 billion worth of services and what if AI eats into this $200 billion pool? People worry about job losses. I worry less about that. IT industry employs 7 million people. So it is not that, it can cause pain to this number, but it may not cause meaningful pain to the whole economy. Because 7 million is 7 million only in a country of 140 billion people or in a country of 300 million families. Why any pain in white collar employment may not be felt meaningfully in the economy is because the blue collar wages have risen much faster and today they are same as white collar wages. A plumber, an electrician, a gym trainer, a beautician, they are probably earning more than many engineers or MBAs. Yes or no? So, if you worry about impact on consumption because of some job losses in IT, please remember that the vast majority of India is self-employed or is blue collar. The dependence of the country on the IT industry for economic activity is reasonably small and modest. And it is not that these 7 million jobs will disappear. Maybe they will not grow, maybe they will come down by 5-10% because GCCs continue to grow. Of the very large banks, investment banks in the world, 20 to 25% of their headcount is in India. So it is telling you that that is the potential, but there are many vast majority of global Fortune 500,000 companies have much smaller proportions of their headcount in India. So I feel the GCCs should continue to grow nevertheless, and that could be a counterbalance to any impact that is felt in IT. So the impact on consumption, I think, should be less. Economy should still continue to grow at a fairly decent pace. However, if adoption of AI indeed impacts IT services revenues, then I think India could have some stress on the balance of payments. I don't know whether it will happen or not. The future will tell us. We need to keep on monitoring. I do feel, I could be wrong, I am not a technical expert, but I feel that the adoption of AI by enterprises will take time. You and I can go on ChatGPT and seek answers. That is very easy. But for enterprises whose systems have been built over decades and centuries, they will move very slowly. They are extremely risk averse. And when I talk to any company, I say if you were to adopt AI in your business processes or whatever, then they clearly tell us it will lead to an expansion in spend on IT. So this is what Indian IT companies like Infosys, TCS have also said, that as enterprises adopt AI, it should lead to an acceleration in IT spends and not compression. That's what I also seem to think on balance, but time will tell. So this is something which we need to be alert towards. At the same time, equities are a hedge against inflation. Equities are a hedge against currency depreciation. Let's assume that IT industry were to degrow. India's balance of payments or trade deficit, current account deficit were to go up. It could mean further rupee depreciation. It could mean higher inflation. It could mean that instead of growing at 11-12%, your nominal GDP may start growing at 14-15%. So your real wealth creation is today 6 to 7, 7 to 8%. Even in that environment, it is likely to remain around those levels. So equities are a hedge against higher inflation, higher rupee depreciation, and we should not worry about it. In fact, 5 years, 10 years down the line, as storage becomes very cheap, as solar becomes a viable source of electric cars, of power, it is possible that India may eventually turn out to be even a current account surplus, but we will get that answer over the next 5 or 10 years. So apart from this, I am unable to see any other meaningful risk. One risk, of course, is it has always been there that the world is running very high fiscal deficits. And most governments in the West seem unable to or unwilling to bring down the fiscal deficits. Now, to what extent this can impact cost of capital? Where will US 10-year yields go? Especially if this fancy towards AI goes away. See, US has received lot of capital driven by the AI stocks. And what if it goes away? Does dollar become weak? Do US yields move higher? Japanese yields are already moving higher. So I think that remains a risk. I don't think it will impact India's economic growth, but it could lead to one more round or two more rounds of foreign-based selling. It could lead to volatility in Indian markets, but even there, as we have discussed right in the beginning of this talk, that Indian markets are increasingly being run by local capital. So I would not worry too much about that. Any dips in these markets on account of foreign selling should clearly be an opportunity to increase exposure to equities. So to conclude, I feel the future of India is extremely bright. The government is working with in a very clear direction. This economy continues to go from strength to strength. We used to grow 5 to 6% in the past. We are currently growing 6 to 7%. In future, we have every possibility how we can grow at 7 to 8%. Our macroeconomic fundamentals are extremely strong, extremely stable. We have very low current account deficit. We have a moderating fiscal deficit. Despite these transfers of cash which are taking place at the state level, the centre's fiscal account deficit continues to move lower. And as per Indian laws, there are limits to the borrowing of states and to their fiscal deficits. So I don't think this poses any risk to macroeconomic stability. The key here is to appreciate where are the markets. We are not a deeply undervalued market. Therefore, our return expectations of the future should not be guided by the last 5 years. Rather, they should be guided by 10 and 20-year returns of Nifty, and they should be guided by the extremely low levels of inflation that India is experiencing, which has brought down our nominal GDP growth rates, and therefore it will bring down the growth in corporate profits as well. These markets have consolidated for 15 months. They've been flat. 40 billion of selling has taken place. Yet these markets have remained firm, the large caps. This displays a lot of resilience in these markets. I feel that in the Indian context or in a context where businesses are growing, economy is growing, an extended period of time correction, after an extended period of time correction, the next move in the index should be on the way up and not on the way down. One final thing here, last 2 years have seen record amount of capital raising, almost 5 lakh crores a year. Today, 55% of the issues of last 15 months are trading below their issue prices. So the appetite, the interest in the markets towards new issues has moderated. Therefore, I feel that in the current year, the amount of capital that will go towards primary markets should be lower than the last 2 years, and therefore a larger portion of the flows of mutual funds should get directed towards the secondary markets. And therefore I feel in large caps the risk is limited in these markets, and the current period of consolidation, I think investors should use it to increase their allocations towards equities, especially large caps. So let me stop here. We have 4 or 5 minutes. In case there are 1 or 2 questions, I can address it. Yes, thank you.
Hi, sir. So you are referring to large enterprises being very skeptical to move towards artificial intelligence. So given at this point in time, in terms of the long-term valuation, would you say it's a time for us to look into IT per se with a long-term perspective?
See, I think the long term is known lesser and the short term is known more. So how AI impacts IT 5 years down the line is very hard to say. But next few years, I don't think much is going to change. Looks like that because enterprises move very slowly when it comes to adoption of technology. In the last budget, the taxation on buybacks was changed. It was made more attractive to undertake buybacks. And these are cash flow generating machines. So I feel that the risk reward in IT is pretty decent. However, please appreciate that in equities, we always see why do we remain diversified? Diversification is humility applied to uncertainty. So we are dealing with a very uncertain world. We are dealing with the world we don't know. Technology, the way it is changing, trades, the way they are changing. So I think in this market, there are no deeply undervalued sectors. The dispersion in valuations is one of the lowest across sectors that I have experienced. So this is a market, in my opinion, where your portfolio should be fairly well diversified across sectors. But I would say even IT offers reasonable risk reward in a portfolio context because this is my view. But how technology shapes is not known. But still, I feel it's a reasonable risk reward. Yes.
Good afternoon, sir.
Yes.
This context, I would like to know why Chinese markets are growing and will there be any direct or indirect impact on the Indian markets?
If you go back 15 months, India's premium to EMs was extremely high. 15 months back, Chinese markets had done nothing for decades and Indian markets were doing extremely well. So I think that momentum priced Indian markets to a very unreasonable extent. And foreigners have sold 40 billion. Why did foreigners sell? I think there were 3 reasons. One, Indian markets became very expensive. It was written about widely. 2, the earnings expectations of foreigners from Indian markets were way too high. They were unrealistic. Because inflation has come off, your profit growth has slowed down. And number 3, money has moved from non-AI themes to AI themes world over. So think of it this way, India has no AI place. So money has gone to Korea, Taiwan, Japan, China, US because these are countries that have plays on AI. So I think this could be one reason why Indian markets have underperformed. I think today, where are we? The premium of India over emerging markets has come back to normal levels. Earnings expectations in India are very realistic. Currency has sharply depreciated. And it has been experienced in the past that after a sharp depreciation of the rupee, in the future, the depreciation is much lower and the foreign flows tend to come back. So while I don't think foreign flows really make an impact on India because the local capital is far bigger, but still I remain optimistic on that front as well. I don't think Chinese performance one way or the other impacts Indian markets. Indian markets are driven by local capital. Compare 5 lakh crores of money going into the markets every year. Foreigners may sell 10, 20 billion dollars this way or that way. It will have not much impact. So I think we are in a very good situation. Indian markets should deliver returns with lower volatility and should have lower dependence on foreign capital flows. I think we have come to the end of the time. So thank you very much.
Thank you,
It was a
Mr.
real
Prashant
pleasure
Jain,
being
sir.
here.